Very good morning, everyone. How are you all? Super. Very fine. Today we are going to start lecture number 5 for CA Inter Advanced Accounting Regular Batch. Last day we were doing Accounting Standard 10 Property, Plant and Equipment. Once let us revise whatever we have done. First, what is the definition of PP? The PP are tangible items which are held for production of goods or for supply of goods or services or for rental to other or for administrative purpose and are expected to be used for more than one period. Correct? Then we have understood that if there are any spare part, standby equipment or servicing equipment, and if it meet a definition of PP, then we'll classify such item as PP and apply AS10. But if it does not meet a definition of PP, then it will be classified as inventory and we need to apply AS2. Okay, sir. Then we came to recognition criteria. Recognition criteria says that the cost of an item of PP will be recognized as an asset if and only if two conditions are satisfied. It is probable that future economic benefit will flow to the entity and the cost of such item can be measured reliably. If both the conditions satisfied, definition means I am saying definition criteria, and both the condition of recognition criteria satisfied, then item will be recognized as PP. So it means then we need to do initial and subsequent recognition of PP as per AS10. Okay. Now initial recognition, in that measurement will be done at cost. Now what is the meaning of cost? Cost means cash price equivalent. What is cash price equivalent to what AS10 says that if the payment is not deferred beyond normal credit period, cost price will be equal to cash and cash equivalent paid. But if the payment is deferred beyond normal credit period, in that case, cost price will be equal to present value of all future payment, which is nothing but purchase price at normal credit terms. Now we can say purchase price. When I say purchase price, so purchase price means what? When I say purchase price, the purchase price means invoice price less trade discount and add non-refundable tax. So this is purchase price. The purchase price at normal credit term will be the cost price. That is nothing but present value of future payment is the rate of interest is given. And the difference between future payment and the present value of future payment will be the interest, and that interest will be recognized as an expense over the period of credit unless it is covered under AS16. AS16 coming soon in your life. Then we discuss about elements of initial cost. There are three elements. First is purchase price. Purchase price means invoice price less trade discount rebate plus non-refundable duties and taxes. Correct. Then directly attributable cost. Directly attributable cost means incremental cost which will be incurred only when such item is acquired or constructed. Means any cost which will be incurred even if such asset is not acquired or constructed, that is not directly attributable, that will be ongoing expenditure and that will be charged to PL as an expense. Correct. What are the examples of directly attributable cost? We have done many examples. Employee benefit cost, which are directly attributable for construction or acquisition of PP. Transportation cost, installation expense, assembly expenses, site preparation cost, consultant fee, testing cost. Cost of testing will be also capitalized, but it will be reduced by any sale proceed from the produce during the testing period. Yes, sir. Then the point number C means the third element is what? Initial estimated cost of dismantling or removing the item or restoring the site where it has been located. So if there is what AS10 says that if there is an obligation of DRSL means what? Decommissioning, restoration, similar liability when the item was acquired. So if there is an obligation of DRSL when such item was acquired, then it will be capitalized to the cost price of asset. And of course, we have understood that provision should be also created as per the requirement of AS29, and provision will be created at present value of future expenditure. So present value now you know, correct? It will be capitalized. But if the obligation of DRSL is not incurred then there is no need to capitalize it. Then no capitalization. I have given an example of AC. Then second example of I have given about building where we constructed artificial wall. As per contractual agreement, we need to demolish it once the lease term was over. You remember that example? Yes, sir. Then we have done self-constructed asset to the elements remain same. Only we need to be careful about allocable cost. If there are some allocable cost, that will be allocated as per the information given in the question. Abnormal loss will be charged to PLS and expense. It will never be capitalized. Any internal profit will be also eliminated. Yes, if there are some income and related expenses arising from incidental operation that may occur either before or during the construction period, then that will be also transferred to profit and loss account. Correct. When to cease capitalization? Will cease capitalization during initial recognition once the item is ready for its intended use. What are excluded from cost price? Any expenses which are not directly attributable will be excluded from cost price. We have done many examples. Cost of opening new facility, staff training cost, any advertisement and promotional cost, administrative and other general overhead, initial operating loss, cost incurred after the asset ready for its intended use, and till the asset is actually put to use, and relocation and reorganization cost. Correct. Borrowing cost will be capitalized as per AS 16 and government grant may be deducted as per the requirement of AS 12. This much we have done in the last class. Now, one point is left. We have done these 2 points also, small point, PP purchase for consolidated price. So in that case, the consideration whatever is paid will be allocated to each item of PP in the ratio of the fair value, and the fair value will be given in the question. PP held by lessee and the finance lease as per the requirement of AS 19. Okay. Now let us do PP acquired in exchange of non-monetary asset. We have understood that we are doing what? We are doing exchange transaction. Exchange transaction. Let me explain you. We are doing purchase of PP in exchange of other asset. And normally it happens, suppose we have old car and old car we want to sell, so we'll go to the market, we'll purchase new car in exchange of old car. Of course, there will be some consideration, cash consideration will be also involved. But can you see in that case, we are purchasing new car in exchange of old car. Got this point? So in that case, what we'll do? Let me take one example. Suppose the carrying amount CA. Whenever I write down CA does not mean chartered accountant in my class. CA means carrying amount. Carrying amount means book value. Book value. So we normally call it carrying amount. Carrying amount. So carrying amount of old car. Carrying amount of old car is equal to 2 lakh. Now I'll give you case 1, case 2, case 3 and leave one space for case 4. That case 4 I will do at the end. We'll do case 1, case 2, case 3. Now fair value of old car is equal to 3 lakhs. So what do you mean by fair value? Fair value means at what price it can be sold today if it is sold today. Correct now. Means what amount can be realized on sale of such asset. That is nothing but fair value. So fair value of old car and fair value of new car, whatever you want to purchase, is also 3 lakh. Correct. So can you see if the fair value of old car and new car are same, then of course no cash consideration will be involved. So can you see in this case, cash paid or received will be nil. And can you see this exchange transaction is practically possible because the fair value of both assets are same. In that case, what is the cost price of new car? Cost price of new car. The cost price of new car can be either fair value of old car given up or fair value of new car received. Fair value of old car given up or fair value of new car received. So this will be the fair value. And both fair value are same, so this becomes the cost price of new car. Means right now we are doing AS16, sorry, AS10 to identify the cost price of new car. This is the objective. Objective you understood? Yes, sir. I think case 1 is very simple. Coming to case number 2. If fair value of old car is 3 lakh, but fair value of new car may be higher, that is 6 lakh. Yes, sir. Can you see, in that case, this transaction, exchange transaction is practically possible if some cash will be paid. Means we need to pay some cash because we are acquiring a new car whose fair value is more than old car. So in this case, can you see, we need to pay 3 lakh and this 3 lakh will be paid. So in this case, what will be the cost price of new car? So can you say cost price of new car? Cost price of new car will be equal to, either we can say fair value of old car, fair value of old car plus cash paid, that is 6 lakh, or we can say fair value new car. Both amount will be same. Both amount will be same. So it will be 6 lakh. It will be 6 lakh. So what our AS10 says that cost price of new car will be equal to fair value of old car plus cash paid, or fair value of new car, whichever is clearly evident. Means which the fair value which is known to you, that fair value you take. Means if the fair value of old car is known to you, then the cost price will be equal to fair value of old car plus cash paid. But suppose the fair value of old car is not known to you, it cannot be determined, then in that case you can take fair value of new car. Okay, sir. Third case. Third case, suppose the fair value of old car is 6 lakh and new car is 3 lakh. Practically possible. It is quite possible the new car, whatever you are purchasing, may be Maruti Omni car, and the old car, whatever you want to exchange, that might be Mercedes Benz. Quite possible. Understood? It is quite possible. Means the fair value of old car, which is Mercedes Benz, which is very high. Correct? Yes, sir. It is quite possible. Here is, in this case, this exchange transaction is possible only when 3 lakh will be received, when the cash of 3 lakh will be received. In that case, can I say cost price of new car will be equal to fair value of old car minus cash received, fair value of old car minus cash received, or fair value of new car, whichever is clearly evident. Means in this case, the cost price of new car will be 3 lakh. Understood? Have you understood? I think no doubt. No doubt about the journal entry. But no doubt about the cost price of new car. Now, of course, we can think about journal entry. Let us do journal entry. Journal entry. So, journal entry will what? Here is a new car account debit. There may be some cash coming in, debit to old car and to cash if paid. Okay. The difference will be gain or loss. Any difference will be gain or loss. Now you will say me, what will come in the first case? What is the cost price of new car? 3 lakh. And old car, which amount will come? Old car will be credited by which amount? So old car will be credited by which amount? Just try to understand. If you are saying 3 lakh, it is not correct. Because right now you are de-recognizing old car and you need to de-recognize the old car at its book value. Book value is what? 2 lakh. It means you are de-recognizing your old car at its book value 2 lakh, and there is no cash involvement in the first case. So this will be what? Gain on sale of old car, which will be transferred to PL. Which will be transferred to PL. First case you understood. Normally student do mistake यहाँ पर. This is danger. Understood why danger? They will not take book value, they will take fair value. But we are de-recognizing the old car. So be careful. Yes, sir. Then coming to second case, what is the cost price of new car? 6 lakh. How much cash paid? That is 3 lakh. What is the book value of old car? 2 lakh. So once again, there is a gain of how much? There is a gain of 1 lakh. Understood? I think simple. Simple na? Yes, sir. Third journal entry, you to buy your own. Now, what is the cost price of new car in case of third case? 3 lakh. How much cash you receive? 3 lakh. And this is what? 2 lakh. Correct. So in this case, what is the gain? Gain is what? 6 minus 2. So 4 lakh is the gain. 4 lakh is the gain. I hope you are able to understand whatever I am saying. Got this point? I think first case, second case, third case you have understood. First case, second case, third case you have understood. Yes, sir. Coming to fourth, one more case, which will be more interesting. Suppose, let's say, suppose the fair value of old car is 3 lakh. Understood? And fair value of new car is 5 lakh. And 1 lakh cash paid. 1 lakh cash paid. Now, in this case, just try to understand. If you take fair value of old car plus cash paid, it will be 4 lakhs. And fair value new car will be 5 lakh. Means what formula I have given? I have given either you take fair value of old car given up plus minus cash paid, or you take fair value new car. And in case number 1, 2, 3, both were same. In case number 1, 2, 3, both were same or not. But in case number 4, what happened? The fair value of old car plus cash paid is 4 lakh. And fair value new car is 5 lakh. Now the question is that the cost price of new car will be 4 lakh or 5 lakh? Doubt will come. So cost price of new car will be what? Just try to understand whenever we say cost price. So cost price means consideration paid. Consideration paid means consideration given up. Correct now. Therefore, AS10 says that first preference will be given to the consideration paid or consideration given up, and therefore will take fair value of old car given up plus minus cash adjustment. Plus minus cash adjustment. If the fair value of old car is not determinable, then find out a fair value of new car. Got this point? In this case, first preference will be given. First preference will be given to what? First preference will be given to this. And therefore, the cost price will be equal to what? 4 lakh. This is very interesting. Understood. Understood why first preference has been given to the fair value of old car given up? Because whenever you purchase, suppose you purchase plant, account debit to bank, this is cash, entirely monetary transaction. Suppose the fair value of this plant is 5 lakh, but cash paid is 4 lakh. My question to you all, the cost price of the plant will be 5 lakh or 4 lakh? Whatever consideration paid, because initially we measure at cost price, and cost price means consideration paid, not the fair value of that plant. So initial measurement is done at cost. Initial measurement is never done at fair value of this plant. So fair value of new car is what? Fair value of new car is 5 lakh, but we never do initial measurement at fair value. We do initial measurement cost. Cost means consideration paid. So first preference will be given to the consideration given up, which will be equal to fair value of old car given up plus minus cash adjustment. But if that is not measurable, fair value is not determinable, then you can give second preference to fair value of new car. Understood? In this case, your cost price of new car is 4 lakh. How much consideration cash paid? Cash paid is 1 lakh. What is the book value of old car? Is 2 lakh. So in this case, gain is equal to 1 lakh. Understood? Have you understood this? Any doubt? Have you understood this? So I have given you the 4 case. Now what AS10 says, just write down. Write down. Whenever there is a exchange transaction. Whenever there is an exchange transactions, so this exchange transaction can be of two types. First, exchange transaction has commercial substance, or exchange transaction lacks commercial substance. So what do you mean by, sir, exchange transaction lacks commercial substance? Write down for the time being. When we exchange similar asset, means exchange of similar asset without any commercial benefit, without any commercial benefit, correct? First write down, I will explain that. So normally whenever we do exchange transaction, that asset whatever we are exchanging, that will not be similar. For example, when I say old car, new car, that are not similar, correct? Now will you exchange the same new car with the same new car? It is practically impossible. Suppose I have a brand new car, Mercedes-Benz of the same model, and you have also the Mercedes-Benz same model. Today only we purchase, and the fair value also same. Will you exchange? No, why, sir? Will never exchange. Practically impossible. So what I am saying, lacks commercial substance. So sometime it is quite possible that we are exchanging similar asset also. In that case, what need to done? But normally exchange transaction will have commercial substance. In this case, then on cost price of PP acquired will be equal to what? First preference will be given to what? Fair value of asset given up plus minus cash adjustment. I hope you understood when I say plus. Plus means cash paid, minus means cash received. If that is not, that cannot be measured, fair value of asset given up cannot be measured, then second preference will be given to fair value of asset received, that is PP acquired, But sometimes what happens, the both fair value cannot be measured reliably. Just try to understand. When I say I want to exchange this mobile with a new mobile, just try to understand what I am saying. New mobile will have the fair value because we know what is the market value of that new mobile. But what is the fair value of old mobile? Here is the fair value of old mobile. Whether we can determine fair value right now, because market price is not always fair value. Every asset does not have market price, but every asset has their fair value. Market price means what? It is old in the market. Right now, this old mobile is not in the market. This old mobile, I am using it, so it does not have any market, so it does not have any market price. Correct? The market price is an indicator of fair value, but every asset does not have market price. It means for finding out a fair value, we need to do some measurement. For that measurement, we need to go to the expert. An expert will charge some fees. So quite possible that we are not able to identify what is the fair value of old mobile. Quite possible. Sometimes what happens? We exchange old mobile with old mobile only. Then in that case, it is quite possible that we are not able to find out the fair value of both assets. Quite possible. In that case, just try to understand, if AS10 has asked you to mandatory measure what fair value, so can you say accounting will become expensive? If I am saying I want to exchange my old mobile with your old mobile, practically possible. Now for accounting, we need to go to the expert because we want fair value. And can you say if you want good, if you for measurement of fair value, if the expert report is required, so accounting will become unnecessary expensive. So for relaxation purpose, what AS10 has given that if you are not able to measure the fair value, then the cost price of PP acquired will be equal to carrying amount of asset given up plus minus cash adjustment plus minus cash adjustment. Understood? Means this will be your first preference in exam. If this fair value is not known, this will be second preference in your exam. If this fair value is also not known, then carrying amount of old asset given will be always given. So this will be your third preference. So can you see for making the accounting what easy, they have given these three preference. I hope you have understood. Yes, sir. But whenever exchange transaction lacks commercial substance, suppose just try to understand if I say, are you getting? If I have say the I want to exchange the same mobile, this mobile with your mobile, and both mobile are similar. So can you say even though I acquire your mobile, whether it will increase my cash flow? No, because this asset have the same capacity, same efficiency. Your asset, your mobile have the same capacity, same efficiency. So if I exchange my mobile with your mobile, my cash flow is not going to change. My cash flow will remain same only, and therefore this transaction lacks commercial substance. This transaction lacks commercial substance. In that case, what our AS10 says that cost price of PP acquired will be equal to carrying amount of asset given up plus minus cash adjustment. Why? Because there is no commercial benefit. We should not recognize any gain or loss on such transaction. Correct? Reason is what? Reason is what? Why carrying amount? The reason what? Because there is no commercial benefit. We should not measure the asset fair value. Correct now? Means if you are exchanging a similar asset and if you are measuring at fair value, ultimately you are doing revaluation. You are doing revaluation, and that revaluation gain or loss you are transferring to PL account. That will be actually not correct from accounting point of view. Therefore, in this case, there is no need to recognize any gain or loss. Gain or loss. Have you understood this point? Correct. Are you able to understand? Means can I say if the same case I will say if the above example, if I will say above example, the transaction lacks commercial substance. Correct now? The transaction lacks commercial substance. So what will be your answer? You know? In the above cases, if exchange transaction lacks commercial substance. Okay. So I have given you case 1, case 2, case 3, case 4. Case remains same. You need to find out cost price of PP means new car acquired, new car. So in the first case, it will be 2 lakh because carrying amount is 2 lakh, 2 lakh plus no cash. So it will be 2 lakh. In second case, it will be 2 lakh and 3 lakh cash paid. So it will be 2 lakh plus 3 lakh, that is 5 lakh. correct? So third case, it will be practically impossible. I need to थोड़ा सा change the question item. Carrying amount of old car, carrying amount of old car, let's say it is 3,50,000. थोड़ा सा change करेंगे, okay, madam. Case 1, case 2, case 3 and case 4. So what is the cost price of new car? This will be 3,50,000. This will be 3,50,000 plus 3 lakh. That is 6,50,000. It will be 3,50,000 minus 3 lakh. That is 50,000. This will be 3,50,000 plus 1 lakh. That is 4,50,000. Understood? Have you understood? We have done plus minus cash paid. So this was the cash paid. Initially it was 0. Then 3 lakh paid. Then 3 lakh received and 1 lakh paid. That only we have done. What will be journal entry? Here it is new car, account debit, cash account debit to old car to cash. The first one, it will be 3,50,000 and 3,50,000. You can see no gain, no loss recognized. Second case, it will be 3,50,000. It will be 6,50,000. Old car 3,50,000 and then 3 lakh. No gain, no loss. Then it will be 50,000. 3 lakh cash received. 3,50,000 and no gain or loss recognized. That is 4,50,000. 3,50,000 and 1 lakh. You can see no gain or loss are recognized. Understood? Have you understood this point? Whenever question says the exchange transaction lacks commercial substance, then you have to apply this criteria. If the question is silent, then always go for this. If question is silent, chalega. Simple, interesting. What is given? Let's see in the book. Case 1, if the exchange transaction does not lack commercial substance, means it has commercial substance, cost price of PP acquired will be equal to fair value of asset given up plus minus cash adjustment, or fair value of asset received or acquired, or carrying amount. Carrying amount means net book value after depreciation of the asset given up plus minus cash adjustment. Case number 2. If the exchange transaction lacks commercial substance, cost price of PP acquired will be equal to carrying amount of the asset given up plus minus cash adjustment. Note, any exchange transaction has commercial substance if the configuration, risk, timing, amount of the cash flow of the asset received differ from the configuration of cash flow from the asset transferred. Means the cash flow from the asset received and cash flow from the asset transferred are different, then it means it has commercial substance. Otherwise, it will lack commercial substance. Got this point? Yes, sir. Same example is given, whatever I have given in the class note. Same example has been given that you can read. Let us do 2 questions. Come to question number 6. Come to question number 6. What is given? Entity A exchange land with a book value of 10 lakh. So land is given up and its book value is 10 lakh. For cash 20 lakh and plant and machinery valued at 25 lakh. Means this is cash received and this is a plant received whose fair value is 25 lakh. What will be the measurement cost of the asset received? Consider that transaction has commercial substance. So first, what you should do, whenever this type of questions come, you should write down this way. Question number 6. What is the book value of land given up? That is 10 lakh. What is the fair value of land given up? That is not known. Then what is the fair value of plant received? That is 25 lakh. And how much cash received? Cash received is how much? That is 20 lakh. This is the entire detail. So we are here to find out the cost price of plant acquired. That will be equal to fair value asset given up. That is not known. You will take fair value asset received. That is 25 lakh. 25 lakh is the cost price. Simple. Normally what happens when we take fair value asset received, then don't do any adjustment of cash paid or received. Normally student do mistake यहाँ पर. First preference will be fair value of asset given up, and that is not given. So ignore it. Now fair value asset received. Fair value asset given up, in that you will do plus minus cash adjustment. Got this point? So what will be your journal entry? Journal entry what? Plant account debit. What is the cost price? 25 lakh. So this is the cost price. This is not fair value. Initial recognition we are doing at cost price only. Chalega. 2. Land. What is the book value? 10 lakh. Then how much cash received? That is 20 lakh. So what is the gain? Gain means what? 45 minus 10. So gain. This is gain on sale of land. That will be transferred to PL. That is 35 lakh. This is 35 lakh. Okay, sir. Chalega. Question number 6 done. Same thing is given. Check karo. Same answer is given. Come to question number 7. Entity A exchange car X with a book value of 13 lakh. Car X is given up. And fair value is 13 lakh 25,000 for cash. And what is the fair value of car X is 13 lakh 25,000 for cash 15,000. And car Y, which has a fair value of 13 lakh 10,000. The transaction lacks commercial substance as the company cash flow are not expected to change as a result of exchange. It is in the same position as it was before the transaction, means the configuration of cash flow remains same. What will be the measurement of the asset received? So question number 7 we are doing. Question number 7. So first write down. What is the book value of car X? So book value is given how much? 13 lakh. 13 lakh. What is the fair value of car X? So fair value is given how much? 13 lakh 25,000. Then they have given fair value of car Y, na? Car Y. Fair value of car Y is 13 lakh 10,000. And cash received is 15,000. Cash received is 15,000. Okay. So we are here to find out the cost price. So I'm just writing in this way, case 1. As per question, can you say exchange transaction lacks commercial substance. Therefore, in this case, cost price of car Y will be carrying amount of car X minus cash received, minus cash received. What is the carrying amount of car X? That is 13 lakh. 13 lakh minus 15,000. That is 12 lakh 85,000. It will be 12 lakh 85,000. Understood? The answer become 12 lakh 85,000. So first we need to understand what is the requirement of the question. Chalega. What will be journal entry? We'll say car Y account debit 12 lakh 85,000. Then cash account debit, that is 15,000. Now to car X is equal to 13 lakh. This is the answer, and you can see there is no gain, no loss is recognized because the exchange transaction lacks commercial substance. But suppose case number 2, this is, I am adding this point, this is not a requirement of a question. Suppose exchange transaction has commercial substance. So suppose exchange transaction has commercial substance, then in that case what will do? Understood? Means this point has been added by me. This is not a part of the question. In exam, don't do both. This is only for your understanding. You can do. In this case, cost price of car Y. So first see whether fair value of asset given up is given. Yes, given. It will be fair value of car X minus cash received. That is equal to how much? 13 lakh 25,000 minus 15,000. That is 13 lakh 10,000. Now you must be thinking, sir, better take 13 lakh 10,000. Okay, in this case both are same. In this case 13 lakh 25 minus 15,000 and 13 lakh 10,000 is same. So you can't, of course your answer will be correct if you are taking fair value of car Y. But in other question it will not be same now. The first preference should be given to fair value of car given up plus minus cash adjustment. You need to go with the rule. Why you are going against the rule? The first preference take what? Fair value of car X given up plus minus cash adjustment. Many question quite possible in the solution they have given this, but because they know the concept they are adding this. But in the different case you need to understand first preference should be given to fair value of car X given up plus minus cash adjustment. That is the only what concept. Yes sir. In this case car Y account debit 13 lakh 10,000. Cash account debit how much? That is 15,000. To car X how much? Batao. So car X will be how much? If you are saying 13 lakh 25,000, that is not correct. It will be book value, and book value was how much? 13 lakh. It will be 13 lakh, and you can see there is a gain. To gain on sale of car X transfer to PL will be 25,000. Understood? Chalega. I hope you have understood this part. Okay, sir. Yes, sir. So we have done two questions. 6 and 7. 22 you do by your own. Chalega. Yes, sir. So we have completed initial recognition. Once we complete initial recognition, now we'll come to subsequent recognition. Subsequent recognition. The subsequent recognition means what? Subsequent recognition means recognition at each reporting date. Means we need to find out carrying amount of property, plant, equipment at each balance sheet date. For that purpose, AS10 has given two options. Correct? So what AS10 says that entity can either apply cost model or they can apply revaluation model model. Cost model or revaluation model. This is choice given. So that will be decided by what? Management. In the question that will be informed whether it is cost model or revaluation model. Correct. Now under cost model, how to find out a carrying amount or PP at the end of each reporting date? So that will be cost, whatever we have understood right now, initial cost as per initial recognition, less accumulated depreciation and less accumulated impairment loss. So what is impairment loss? Impairment loss is totally a new name in your life. But depreciation, no. So depreciation is actually calculated as per the requirement of AS10 and impairment loss is calculated as per the requirement of AS28. Understood? So impairment loss right now we will not discuss because impairment loss will understand only once AS28 has been done. So right now we don't know about AS28. It is totally a new terminology for you. Correct now. But one thing we have understood, depreciation and impairment loss are different. Depreciation and impairment loss are different. Correct? Yes, sir. So we'll discuss about impairment loss, but not now. So even though I am reading impairment loss because that is a part of AS, because that is a part of this particular concept, but impairment loss detailed discussion will be done under AS20. So we can say cost less accumulated depreciation is equal to carrying amount. Correct. In case of revaluation model, the revaluation model it means will remeasure the asset at its current fair value. We'll take fair value on revaluation date. Fair value on revaluation date. Correct. Then less any subsequent accumulated depreciation. Then any subsequent impairment loss will be deducted. This will become carrying amount. Once again, this depreciation will be also as per AS10 and this impairment will be as per AS28. Is one thing is clear that under both the model, whether it is cost or revaluation, asset will be depreciated, asset will be impaired. Asset will be depreciated, asset will be impaired. Chalega. Can I say in case of cost model, because cost we have done, depreciation will understand. So nothing to discuss much about cost model. But in case of revaluation model, if we are doing remeasurement of fair value, we need to understand that accounting for revaluation. So that we need to understand. Chalega. So now we'll do some discussion about revaluation model. We are coming to revaluation model. One thing is clear that when I am saying revaluation model, when I am saying a revaluation model, correct? Understood? So in case of revaluation model, we measured PP at fair value. At fair value. So we compare carrying amount on the date of revaluation, on revaluation date. Revaluation date. Carrying amount means book value. If you want to write down book value, but better time is carrying amount, and therefore I am writing what? Carrying amount. Book value. Book value of such PP on revaluation date. I mean to compare with what? Fair value. We'll compare with what? Fair value now. Chalega. We'll compare with fair value. We will say fair value of such PP on revaluation date. Correct. And the difference of these will be either gain or loss. We call it revaluation gain or loss. Now we need to understand Whether this gain or loss means what will be the accounting treatment of such gain or loss, that we need to understand. What will be the accounting treatment of such revaluation gain loss? Chalega. Correct. Now, if there is a gain, we call it upward revaluation. We call it what? Upward. When there is a loss, so we call it downward. We call it downward revaluation. Okay, sir. Yes, sir. Yes, sir. Correct. Now the question arises, just try to understand. Whenever entity want to have revaluation model, whether we need to revalue all assets, it is practically impossible. It is practically impossible because there will be some item for which fair value cannot be measured reliably. In that case, if they will say it is for all assets, then the entity will die. Are you getting what I am saying? So once again, it is an option given, and that option is available class wise. So what is the meaning of class wise? So this option revaluation is done class wise. Class wise means what? We need to make category of asset as per the nature, as per their nature. Okay, so class wise. For example, land is one class, building is one class. In building also we can say factory building is one class, office building will be different class, plant can be one class, furniture can be one class. Are you getting? These are different class. Now suppose land, may we have land A, land B, land C, land D, and we opted, we want to opt revaluation model for land A. So if we want to opt revaluation model for land A, then we to also opt revaluation model for all the asset, all the item under that class. Means we need to opt revaluation model for this, revaluation model for this, revaluation model for this. But if you have opted revaluation model for land, it does not mean you need to opt revaluation model for other asset. You can opt cost model for building, and you can opt revaluation model for office building, your choice. It is your choice. And you can opt cost model for plant. You can opt cost model for furniture. Cost model for furniture. Understood? This is one example I have given. It does not mean if you want to opt revaluation model for one class, you need to opt revaluation model for all the class. But yes, if you want to opt revaluation model for one item under one class, then all item under that class, we need to opt revaluation model only. Got this point? So this option is available class wise, not item wise. This option is available class wise, not item wise. The revaluation to be made for the entire class of the asset. If an item of PP is revalued, then entire class of PP to which such item belongs should be revalued. In other words, revaluation should be applied class wise. Understood? Now, second point, what about the frequency of revaluation? Now, the question arises, sir, if we have opted revaluation model, so whether we need to revalue the asset on annual basis, AS10 says no. So there are two types of assets. Any asset for which there is a significant changes in the fair value of asset every year. For example, land, here is the fair value will significantly change every year. So in that case, we need to revalue such asset on annual basis. But if the fair value of asset will not change significantly every year, in that case, revaluation can be done after 3 to 5 years as per management policy. The frequency of revaluation, if the item of PP experience significant change in fair value, then we can go for annual revaluation. But in other case, revaluation after every 3 to 5 years. Correct? Now one more question will come, sir. Revaluation should be done at the beginning of the year or at the end of the year, at any point of time during the year. For this, AS10 is silent. It means revaluation can be performed at any time during the year. Practically speaking, revaluation is done at the end of the year. but from examination point of view, it can be done at the beginning of the year also. Correct now. So revaluation can be performed at any time during the year. Revaluation can be performed at any time during the year, means as per the information given in the question. Chalega. Now coming to the accounting treatment revaluation, that is very very simple. Very very simple. It depends upon whether you are doing revaluation of such item for the first time or for the subsequent time. So first time revaluation, if upward revaluation, so there is a revaluation gain. The revaluation gain, you only say it is realized, unrealized. So can you say it is unrealized? And as per conservatism principle, we can't recognize any expected gain because that gain will arise on actual sale. Correct? So it is expected gain. So we need to be conservative, and therefore AS10 says that we need to revalue asset for the fair disclosure. Because when we say measurement should be on fair basis. If the asset you acquired 20 before at rupees 1 lakh, and now due to market changes, the price of that asset become 20 crore. So of course, you should give correct information to the user of financial statement. So we should do measurement of fair basis. There is no doubt. But can I say if there is gain, that gain should not be transferred to PL account because that will be against conservatism principle. Therefore, AS10 says that if there is a revaluation gain, that revaluation gain will not be transferred to PL account. It will be accumulated in a special account known as revaluation reserve, and that will be shown under the head reserve and surplus directly in the balance sheet. Okay, so this will be credited to revaluation surplus or revaluation reserve. Means what journal entry will do? What journal entry will do? Will do PP account debit to revaluation reserve. Okay, journal entry I will write down separately. Then is a downward revaluation. There is a downward revaluation. So there is a loss. Loss as per conservatism principle should be charged to PL account. So this will be immediately transferred to PL account. Will pass one journal entry. PL account debit to PP. PL account debit to PP. So what will be journal entry? So accounting treatment. When I am saying accounting treatment, first time revaluation, if revaluation gain, what journal entry will do? PP will increase in asset will be debited, and the gain will be created. All incomes are created, but this gain will be transferred to revaluation reserve. Correct. Point number 2, a revaluation loss. What journal entry will do? We'll say revaluation loss, and this will be transferred to PL account to PP. So like you can directly say PL account debit to PP also. Any doubt? Yes sir, no doubt. Now coming to subsequent revaluation. The subsequent revaluation, what will do? First, subsequent revaluation. The subsequent revaluation means what? After initial revaluation, then again we are doing revaluation for the second time, third time. It can be n number of times. Now, the accounting treatment of subsequent revaluation depends upon initial revaluation. See, previously there was upward revaluation, and now again upward. Means previously gain, again gain. So that gain will be transferred to revaluation reserve. So previously upward, again upward, the gain will be created to revaluation surplus. But previously upward, now downward. So now there is a loss. What AS10 says, this loss will first adjusted to revaluation surplus available. Any balance loss will be debited to PL account. Any balance loss will be debited to PL account. So now downward, charge revaluation surplus to the extent available. Charge PL for balance if any. Have you understood? Right on. Subsequent revaluation is in this write-off. Point number 1, previously upward, correct? Now again upward. Then what is journal entry? PP account debit to revaluation reserve, correct? Then point number 2, now downward, means loss. This loss will be first adjusted to what? Revaluation reserve, the balance of revaluation reserve to the extent available. We will say revaluation reserve account debit. Any balance will be debited to PL account to PP. Which this will be balancing figure. This will be balancing figure. Simple. Correct. Now you can do by row. See point number 2, previously downward. If I say point number 2, previously downward, and now again downward. Means previously lost, now also lost. This loss will be once again debited to PL account. What journal entry will do? PL account debit to PP. But now upward. You will say what will do? Means previously lost, and previous loss was debited to PL, and now it is what? Upward. So can you say previous loss which was debited to PL, now it should be reverse? It means in this case, what we are supposed to do? Whatever gain is there, that will be first credited to PL to the extent of previous decrease. Correct? Means to the extent of previous debit to PL account. How much you have debited to PL account? And balance will be credited to revaluation surplus. Revaluation surplus. This is balancing figure. Got this point? This will be to the extent of previous decrease. Understood? Super easy. Accounting is very easy. Okay. One time you revise, it will be in your mind forever. What is given? Previously downward, now again downward, charge to PL account. But previously downward, now upward, credit to PL to the extent of previous decrease, and any exchange gain transferred to revaluation surplus. Okay, sir. Accounting you have understood about revaluation? Yes, sir. Now coming to adjustment of carrying amount of asset due to revaluation. I mean, right now we have done accounting treatment, but there is some presentation technique. So they have given two techniques of presentation. Whenever they give option in accounting or presentation, means one option is fair, one option is what? Easy. So whenever you are not able to apply fair accounting treatment, then apply simple accounting treatment. So whenever option is given, right now here option was given, cost model, revaluation model. This is fair accounting. But can you just try to understand? Fair accounting means fair disclosure. Because of course, property, plant and equipment should be measured at fair value only. Because we are here to give true and fair view of our financial statement. True and fair, so fair presentation, fair value. But just try to understand, if this option is mandatory and no choice of cost model is given, once again accounting will become complicated. Accounting will become expensive. So for ease of accounting, one option has been given. If you don't want to have revaluation model, then you can opt cost model. So whenever options are given, one will be simple, one will be fair. correct? In this also, they have given technique 1 and technique 2. Let me explain. We are doing adjustment of carrying amount of asset due to revaluation. Means you can add on presentation. We are discussing about that is adjustment to carrying amount of asset. Let me take one example. First, we are doing technique 1. Technique 1. Let's say before revaluation. This is gross book value. Gross book value means cost price. Okay? Gross book value. Then from this will deduct accumulated depreciation and this will become net book value. So gross book value less depreciation, so that become net book value. Now gross book value will be cost price under cost model and it will be fair value under revaluation model. Which if you are measure at fair value, the gross book value will become fair value. Correct now. It will depend upon cost model, revaluation model. So when I say gross book value under cost model, it is cost price. When I say revaluation model, under revaluation model, gross book value will become fair value. Initially, suppose gross book value was 1 lakh, this was 60,000 and this was 40,000. Correct. And because we have done revaluation and now the fair value become 1,20,000, there is a revaluation gain. Revaluation gain, and suppose revaluation gain of 80,000. It means, can you say this 1,20,000 is the revised carrying amount after revaluation? This is the net book value. This is the 1,20,000. This is the net book value, and this is nothing but fair value. Because what you have done, fair value is 1,20,000, carrying amount is 40,000, so your revaluation gain is what? 80,000. But the question is that, what will be the accounting treatment? Just try to understand. Normally, this 80,000 what generated into PP account debit to revaluation surplus? Means when I say accounting treatment, my first journal entry what PP account debit to revaluation surplus. So when I say PP account, so PP account represents gross book value and accumulated depreciation separate account. So already in my basic concept I said normally we should pass journal entry for depreciation account debit to accumulated depreciation. So this gross book value represent PP account. This gross book value represent PP account now. Correct? And accumulated depreciation will be a separate account. And net book value, for net book value we don't prepare any account. So gross book value minus accumulated depreciation, the balance sheet will be the net book value. When I say PP account represent gross book value. So can you say you will add 80,000 here? Correct. So it will become 1,80,000. But the fair value is what? Fair value is 1,20,000. So can I say there is some mismatch? There is some mismatch because this after this should be this should be 1,20,000 because right now the fair value is 1,20,000. There is some mismatch and therefore what our accounting suggests that whatever accumulated depreciation that will be adjusted here will be eliminated through gross book value account. Means this now will eliminate and you can see we'll do minus 60 and here also we'll do minus 60. This is the adjustment for what? Accumulated depreciation. So what we have done? We have transferred accumulated depreciation to PP account. Means we have closed accumulated depreciation account. Past accumulated depreciation account. Means one more journal entry will do. Accumulated depreciation account debit to PP account. Understood? So this journal entry with 80,000 and this journal entry with 60,000 and ultimately what is the end result? This will become nil, and you can see the gross book value now represent fair value. Gross book value now represent fair value. This is technique number one. In technique number one, our AS10 says that accumulated depreciation should be eliminated through gross book value, means PP account. Chalega. Now, in this case, if you are presenting, means what is the post revaluation presentation? What happened? In the balance sheet, we write on PP. PP, what is the gross book value? The gross book value will be 1,20,000. What will be the accumulated depreciation? This will be nil. And what is the net book value? 1,20,000. Understood? This is the technique number one. Have you understood? It means now whenever you are passing any journal entry for revaluation, there are two journal entries. First, we need to eliminate the past accumulated depreciation through PP account. Then PP account debit to revaluation surplus. The same journal entry for loss also. If there is a revaluation loss, means you need to eliminate accumulated depreciation. Have you understood this point? चलेगा? Any doubt? But you can see there is one limitation of this technique one. I said now it is not fair presentation. Why it is not fair presentation? Because if you see the depreciation become what? It becomes 0. It becomes 0, and hence can I say is not giving fair information to the user of financial statement. What user will think this is the acquired asset? Because depreciation becomes 0, so what user will think? There are 2 points they may think it is either not a depreciable asset or the depreciation means it is a newly acquired asset. So can you say we are not providing correct information to the user of financial statement, so it becomes 0. Hence, not fair presentation. Means accounting is okay, but we are not able to provide correct information to the user, and therefore AS10 has given technique 2. So now we need to understand what technique 2 says. Same example I am taking. Gross book value, accumulate depreciation, net book value. चलेगा? You can add on after evaluation. Same example before. A revaluation is 1 lakh, is 60, is 40. Then we'll do plus a revaluation gain 80,000 and become 1,20,000. Correct? In this case, what AS10 says that because they say that your net book value has increased by 100%. Sorry, 200%. You can see 40,000 increased by 80,000. You can see this is how much increase? 200% increase. And therefore, you should proportionately increase your gross book value and accumulated depreciation. You should proportionately increase these two by 200%. Means this will become 2 lakh. This will increase by 1,20,000. And you can see it will be 3 lakh. And this will be 1,80,000. Ultimately 3 lakh minus 1,80,000 will be 1,20,000. Are you getting? So what we have done, if the same asset was acquired today, what would have been the fair value? So you can see 1 lakh because the net book value has been changed from 40 to 1,20,000. So you need to restate gross book value proportionately. Only for presentation purpose, the net impact in the balance sheet will remain same whether either technique 1 or technique 2. Just try to understand. In this, what journal entry we have done? So accounting treatment, what we have done? We have increased PP account, means gross book value, by 2 lakh, and we have also increased accumulated depreciation by 1,20,000. Difference is what? Revaluation, revaluation reserve, how much? 80,000. Ultimately, you can see your revaluation reserve remains same. And in this case, if you prepare balance sheet, in balance sheet, what will be the impact? Check karo. So we'll say property, plant and equipment, gross book value will be how much? Gross book value will be 3 lakh. Less accumulated depreciation, how much? 1,80,000. 1,80,000. And your PP net book value remains same. Means there is no change in the total of balance sheet. Your total of balance sheet remains same. So we are not affecting the total of balance sheet, whether it is technique 1 or technique 2. Only the presentation has been changed, and now you can see this presentation is more fair because you have restated gross book value and accumulated depreciation proportionately. So more fair technique, more fair technique. But in exam, if the question is silent, I will always suggest use technique 1. If the question is silent, correct? You will not use this technique by your own. But have you understood this? Ultimately, what I am saying, the balance sheet total will remain same because in outer column, in both technique 1 and technique 2, it is 1,20,000. Got this point? So only presentation difference is there. Got this point? Yes, sir. What is given? Technique 1, accumulated depreciation is eliminated against gross carrying amount of the asset. Same example has been given, just check it. Same to same example I have given. In this case, 2 journal entry. Then technique to gross carrying amount is restated proportionately to change in the carrying amount. Accumulated depreciation at the date of revaluation is adjusted to equal the difference between gross carrying amount and carrying amount. Means this difference. This difference, this. Correct. And then 1 journal entry I have given. Okay, sir. Have you understood? Have you understood? Any doubt? No doubt? Simple. बोलो. Simple or not? थोड़ा सा technical, but till now no question of this nature has been given ICAI study material. Read on no question. For this we do not have any question. चलेगा. Any doubt? Read on one example for this. Example. Cost price of PP is equal to 10 lakh. Useful life of PP is 10 years. At the end of year 4, PP was revalued at rupees 12 lakh. Give journal entry for revaluation. Now, whenever this type of question will come, where they are asking only journal entry of revaluation, only when they are asking journal entry of revaluation, there is no other transaction. You can see only focusing on our journal entry of revaluation, correct? So in this case, give both technique in your solution. Give both technique. ठीक है? The solution, write down. Technique 1, accumulated depreciation will be eliminated will be eliminated through gross book value. You can see that only it is given. Accumulate depreciation eliminated against gross carrying amount of the asset. Okay. What was the initial cost price? 10 lakh. Less accumulated depreciation. For 4 years, you will do 10 lakh divided by 10 into 4, because at the end of 4th year revaluation was done. At the end of 4th year, so 4-year depreciation already charged. 4-year depreciation already charged now. Correct? So first we'll calculate depreciation, then revaluation. Always. It is 4 lakh. So what is the carrying amount? This is before what? Revaluation. Before revaluation. That is 6 lakh. Now in this we'll add revaluation gain. What is the fair value? Fair value is 12 lakh minus 6 lakh. So it is 6 lakh. So this become 12 lakh. Understood? And this become revised carrying amount. This is revised carrying amount. We call it revised carrying amount after revaluation. So what will be journal entry? Accounting treatment. First we need to eliminate entire depreciation. Accumulated depreciation account debit to PP. That is how much? 4 lakh. Then second journal what? PP account debit to revaluation reserve. That is what? 6 lakh. Understood. Understood. Means in this case, what is the gross book value? GBP is gross book value. So initially it was how much? 10 lakh. From this minus what? 4 lakh. Then plus what? 6 lakh. It become 12 lakh. Less accumulated depreciation, that become nil. What is the net book value? That is 12 lakh. Chalega. This is only for your understanding what we have done. Chalega. Now technique number 2. The gross book value is proportionately restated for changes in carrying amount. You can see your carrying amount has been changed from 6 lakh to 12 lakh. So how much increase? 100% increase. Correct now. You need to find out surplus percentage. Surplus percentage. So 6 lakh divide by 6 lakh into 100. So 100%. It means you need to increase your gross book value accumulated depreciation by 100%. So what journal entry will do? PP will increase by 100%. So your PP was how much? It was 10 lakh. You will do 10 lakh into 100%. That is 10 lakh. To accumulated depreciation is 4 lakh. That will also increase by 100%. That is 4 lakh. And what will be the revaluation? Surplus. That is 6 lakh. This will be journal entry. Simple. In this case, your gross book value will be 10 lakh plus 10 lakh. That is 20 lakh less accumulated depreciation. That is 4 lakh plus 4 lakh. That is 8 lakh. What is your net book value? That is what? 12 lakh. Same thing came. Understood. Chalega. Only for your understanding, one question I have done. Suppose they ask you the technique 1 and technique 2. However, the chances are rare. Therefore, I have already done no questions. Whenever I read no question, so from exam point, it is not so much important. So you also write a no question. But whenever you are doing revision from exam point of view, you do not give much stress on this. Because if there is no question, ICAI statimetry, the trend is that ICAI will not ask any question on that. Until they have given some question RTP, MTP. That is a trend in ICAI exam. Okay, sir. Got this point. But one example I have done only to inform you what need to be done whenever such questions come. So this technique 1, technique 2 journal entry will be done only when they have asked journal entry only for revaluation. Chalega. Now the last point of this particular concept that we'll do after a small break. Now, can we start once again, everyone? Yes, sir. So we were doing revaluation before the break, and we have discussed up to point number what? This is actually point number 4, and this is what point number 5. So now we are coming to the last point, accounting treatment of revaluation surplus. Now, one thing we have understood, just try to understand, whenever there is a revaluation, so in the balance sheet, what is the impact? Correct. So in the balance sheet, suppose the asset, property, plant and equipment is of 10 lakh. We'll increase it by suppose 5 lakh revaluation surplus. This will come at 15 lakh, and this revaluation surplus will be shown under the head reserve and surplus in the balance sheet. In the equity side of the balance sheet, equity and liability. So this will be what? Reserve and surplus. Under that we write on revaluation reserve of 5 lakh. Now the question is that, try to understand, this is what? Unrealized gain. So what do you mean by unrealized gain? Gain which is not yet realized, and therefore it cannot be transferred to PL because of conservatism principle. Okay, and due to that reason, this gain is not transferred to PL. It is transferred directly to the balance sheet to only inform the user that it is an expected gain which may happen in future. And can I say, just try to understand, in future this asset will be sold, and once this asset is sold, this revaluation surplus will become realized, and therefore can I say now it must be available for distribution or dividend to shareholder. Means once I say unrealized gain, that is not available for dividend, that is not available to the shareholders as dividend. But once it become realized, it is available for distribution or dividend to shareholders, and therefore what AS10 says that when it is sold, this revaluation reserve should be transferred from revaluation surplus to what? Revenue reserve. To revenue reserve. Correct? Means it will be transferred to revenue reserve under the head reserve and surplus only. Got this point? Yes, sir. Now, in this case also they have given two options. In this case also they have given two options. Once again, two options is given, means one is fair accounting, one is simple accounting. So what AS10 says that revaluation surplus of an item of PP may be transferred to retained earning, but normally we call it revenue reserve. Once the asset is derecognized, means once the asset is sold, this gain will become realized gain, and therefore will be available to shareholders as dividend, and therefore it should be transferred from revaluation surplus to revenue reserve. Means what journal entry will do? Option number 1. Right now we are doing accounting treatment of revaluation surplus, means accumulated gain, revaluation gain. Means this is nothing but accumulated revaluation gain. So what is the option number 1? On derecognition. On derecognition of PP, means on sale of asset, will transfer revaluation surplus to revenue reserve, means will decrease revaluation reserve account debit and will increase revenue reserve. This journal entry will do. Okay, sir. Chalega. Let me take one example. Journal entry is very simple. Example. Try to understand this example. Thoda sa technical. Means once you have understood, then everything will be easy. Suppose this is Y0 and the cost price of the asset is 100 lakh. Suppose useful life is equal to 10 year. Useful life is equal to 10 year. Correct. Got this point? This is Y1, Y2. So, can you say at Y1 what is the depreciation? Depreciation will be 10 lakh. Here also 10 lakh. What is the carrying amount? Here it is 90 lakh. Here it is 80 lakh. Okay. Chalega. Okay, sir. Now on this date, a revaluation done. There was revaluation. And this asset was revalued by say plus revaluation gain is 40 lakh. So now it become 120 lakh. Now it become 120 lakh. So this become revised carrying amount. And can you say this will be transferred to revaluation reserve? Correct. Now can you say this 120 lakh will be depreciated for the remaining useful life? And the remaining useful life is 8 years. Out of 10 year, 2 year expired. So we'll do 120 divided by 8. So every year 15 lakh will be depreciated. Correct now. So here the remaining useful life is 8 years. We'll do Y3, Y3, Y4 and Y5. And now the depreciation will be how much? It will be 15 lakh, 15 lakh and 15 lakh. Correct. Are you getting what I am saying? And let's say at the end of 5th year, it is sold. At the end of 5th year, it is sold. Means de-recognized. So at the end of 5th year, this 40 lakh will be transferred to revenue reserve. I'm not discussing right now about the journal entry for sale. Journal entry for sale we'll discuss. The objective is to understand what will journal entry for this accumulated gain which has been accumulated in revaluation surplus account. Okay, sir. So what option 1 says? Option 1. Correct? Try to understand. Year 3, year 4, year 5. Your depreciation is how much? 15, 15, 15. So depreciation account debit. Either you will say PP or you will say accumulated depreciation account. Both are correct. Depreciation account debit to PP or depreciation to accumulate depreciation. You will say 15 lakh, 15 lakh, 15 lakh, 15 lakh, 15 lakh, 15 lakh. And this depreciation will be transferred to PL account. This depreciation will be transferred to PL account, no doubt about that. And on de-recognition of the asset, I'm not right now doing journal entry for sale. On de-recognition, we'll pass one more journal entry, that is revaluation reserve account debit to revenue reserve, revaluation reserve account debit to revenue reserve. Here nil. Entire 40 lakh will be transferred to revenue reserve. Got this point? Have you understood? This is option number 1. But now what option number 2 says that, try to listen. Option number 2 says that if there would have been no depreciation, if there would have been no revaluation, then your depreciation would have been 10 lakh, 10 lakh, 10 lakh. And therefore additional depreciation because of revaluation is what? 5 lakh. Are you getting? You can see 40 lakh divided by 8 is equal to 5 lakh. It means additional depreciation because of revaluation is what? 5 lakh. So what option number 2 says that, what we'll do? Will not transfer entire revaluation surplus to revenue reserve on derecognition. Instead of that, what we'll do? We'll transfer some portion of revaluation surplus to revenue reserve during its remaining useful life, and that portion will be equal to the additional depreciation because of revaluation. Correct? It means every year 5 lakh, 5 lakh and 5 lakh and so on will be transferred from revaluation surplus to revenue reserve. Means in option number 2. In option number 2 is year 3, year 4, year 5. Depreciation generative remains same. Depreciation to PP or accumulated depreciation. How much? That is 15 lakh, 15 lakh, 15 lakh. Now what we'll do? Every year during its remaining useful life, some amount of revaluation surplus reserve will be transferred to revenue reserve every year during the remaining useful life, and that amount will be equal to the additional depreciation, and additional depreciation 5, 5, 5. Correct? Means if suppose it was derecognized at the end of 5th year, then the balance entire will be transferred. Means with 5, what is the balance left? So once derecognition, then the entire revaluation surplus will be transferred to revenue reserve. So what is the balance? Out of 40, you have transferred 15. The balance is what? 25. 25 will be also transferred. Got this point? Means suppose this asset was going to be derecognized at the end of 10th year, then every year 5, 5, 5, 5, 5 will be transferred from revaluation surplus to revenue reserve. Understood? This is the second option. This second option, which is more interesting. Can I say this become very simple? Nothing will transfer every year during its remaining useful life. Only will transfer the entire amount of revaluation surplus to revenue reserve on derecognition of the asset, because the asset was derecognized at the end of 5th year. We have transferred entire amount to revenue reserve on derecognition date. But here, what we have done every year during the remaining useful life, we are transferring some portion of revaluation surplus to revenue reserve, and that amount will be equal to amount of additional depreciation. Understood? Correct? Just try to understand. Additional depreciation means entire depreciation, 10 lakh plus 5 lakh, both will be transferred to PL account. Means I'm not discussing that additional depreciation will be transferred to what? revaluation surplus. That I am not saying. Your depreciation of whatever nature, depreciation, entire depreciation, whether on cost price or revalued amount, that will be transferred to PL. But we are discussing about transfer of revaluation surplus to revenue reserve. That amount will be the amount equal to additional depreciation. So this amount is what? Amount of additional depreciation. This will be the amount of additional depreciation, and which can be easily calculated as revaluation surplus divided by remaining useful life. Remaining useful life, that is 40 divided by 8 is equal to 5 lakh. Is equal to 5 lakh. Can be easily calculated. Can be easily calculated. Got this point? Have you understood? Interesting. Normally, they are asking question on this. Not in this chapter, in some other chapter linked with this chapter, they will ask one question on this. You need to understand whatever I am saying. Have you understood? Little technical. I said AS10, once you have understood all other accounting standard will be very easy. Therefore, initially I am taking AS10 because other accounting standard will be easy once you have understood accounting standard 10. Have you understood this para? What they have given? Portion of revaluation surplus may means option is there, either this or this, may be transferred to retained earning. Retained earning means nothing but revenue reserve. Revenue reserve during the remaining useful life of the asset. Amount transferred will be equal to additional depreciation due to revaluation. How to calculate that? Depreciation revalued amount minus depreciation of original cost, you will get the difference. अब in simple way, what will do? Simple way to calculate revaluation surplus divided by remaining useful life, you will get the additional amount of depreciation. Correct. Now, one clarification has been given. Transfer revaluation surplus to revenue reserve are not made through PL. Means you will not transfer revaluation surplus to PL account. Will directly transfer revaluation surplus to revenue reserve account. Correct. Means will not transfer revaluation surplus to PL account. Directly we transfer to balance sheet to another reserve. Chalega. Additional depreciation revalue amount is always transferred to PL. Just one clarification. Depreciation will be always transferred to PL. Whether normal depreciation or additional depreciation, all amount of depreciation will be transferred to PL. Right now we are discussing about the accounting treatment revaluation surplus that will be transferred revenue reserve, and the transfer amount in the second option will be an amount equal to additional depreciation. Means I am not saying that additional depreciation will be charged to revaluation surplus. I am saying amount transferred from revaluation surplus to revenue reserve, that amount will be the amount equal to additional depreciation. Got this point? Have you understood this point? Bolo. Chalega. Now, let us take some question. Come to question of 14. We'll take some questions. Come to question 14. What is given? Arka Limited purchased machinery for rupees 3,000 lakh. Depreciation was charged at the rate of 10% on SLM basis. Now you know SLM basis, even though you have forgotten, you know the formula, but we'll discuss SLM, RBM, everything in detail. For a useful life of 10 years, at the end of year 4, the machinery was revalued at 2,700 lakh and the same was adopted. What will be the carrying amount of the asset at the end of year 5 and year 6? Assume no change in useful life. Super easy. Can we do? We are doing question number 14. Question number 14 we are doing. What is the initial cost? Initial cost they have given 3,000 lakhs. Write down 3,000 lakhs. Correct. Then what happened? Depreciation was charged at a rate of 10% on SLM. 10% SLM is 10% of cost price. So 10% of 3,000 means it is 300 lakhs. For a useful life of 10 years, and at the end of 4th year, Means can you say first we'll charge depreciation for entire 4 year? We'll say less accumulated depreciation, that is 3000 into 10% for 4 year. With 300 into 4, that is what, 1200. So this is carrying amount at year end 4. Yeah, this is before a revaluation. So revaluation is done after depreciation. First depreciation, first find out carrying amount, then revaluation. Correct? So it is what? 1800 lakhs. Now it was revalued at the end of 4 year to 2700 lakhs. We'll say plus add revaluation gain, and this will be credited to what? Credited to revaluation reserve. It is 2700 lakh minus 1800 will become 900 lakhs. Chalega. Understood? Yes, sir. So this become revised carrying amount. We call it revised carrying amount at year end 4. This is after revaluation, and that will be equal to fair value only. And they have said after that useful life remains same. Means useful life was, if the useful life remains same, so can you say your rate of depreciation will also remain? Correct now? Understood? So useful life remains same. So can you say useful life remains same? So initially it was 10%, 10%, and they have given 10 year. So 10 year, 10% are same now. It means it was 10 year. Now the remaining useful life after 4 year, after 4 year expire, it is 6 year. So now it becomes 6 year. So now can you say it will be depreciated for the remaining 6 year? It will be depreciated for remaining 6 year. Okay, sir. So your rate of depreciation is going to change. The rate of depreciation is going to change. It was 10%, or we can do in this way, 3000 divided by 10 into 4. Both are same na? Both are same. So now less depreciation for 5th year, it is 2700 divided by 6. So 2700 divided by 6 is equal to 450. So this becomes carrying amount at year end 5, that is 2250. Then again less depreciation for 6th year. Either you will take same depreciation because SLM, I can say 2250 divided by 5. Now remaining useful life is 5. Same answer will come, check kar lo. So this is carrying amount at year end 6, that is 1800. Chalega? Okay, sir. Are you getting what I am saying? Means if you want to calculate rate of depreciation here, so your revised rate of depreciation will be 450 divided by 2700 into 100. That is actually equal to 16.67%. So your rate of depreciation will change. Now you say 2700 into 16.67 is equal to what? 450. So you can find a revised rate of depreciation. Okay. Understood? Have you understood this? Any doubt? No doubt? Chalega. Understood. Now suppose in this question they would have asked what will be the accounting treatment of revaluation surplus? What will be the accounting treatment of revaluation surplus means how much will be transferred from revaluation surplus to revenue reserve. Madam. Suppose question require balance of revaluation surplus at year end 6. Correct? Madam. That depends upon option. Option 1. Revaluation surplus will be transferred to revenue reserve on derecognition of asset. Then nothing will be transferred because till now the asset is not derecognized. Means what was the revaluation gain at year end 4? It was how much? 900 minus transferred to revenue reserve. Nothing. Therefore, balance at year end 6 will be 900 only in the balance sheet. Or I will say option 2. This is only to explain. Correct? Option 2. An amount equal to additional depreciation will be transferred from revaluation surplus to revenue reserve during its remaining useful life. During its remaining useful life. Understood? In this case, what was the revaluation gain? At year end 4, 900. So minus transfer to revenue reserve. So some amount will be transferred in the year 5 and then some amount will be transferred in the year 6. Means what? 2 years. So that will depend upon what is the remaining useful life. So remaining useful life is what? How much? It is 6 years. We will do 900 divided by 6 into 2. So 900 divided by 6 into 2, that is 300. And you can see additional depreciation is what? 450 minus initially it was 300. So 150 into 2 is 300 only. So 300 will be transferred to what? Revenue reserve, and the balance of a revaluation reserve at year end 6 will be how much? 600. Understood. So this question can be asked. Chalega. I have given both the options. Now, are you able to understand this too? So either these or these, depending upon the information given in the question. Chalega. Yes, sir. One more question will take. Come to question number 15. Kanda Limited acquired a machinery for rupees 2 crore 50 lakh 5 years ago. 2 crore 50 lakh 5 years ago. Depreciation was charged at 10% per annum on SLM basis, useful life being 10 years. Okay. At the beginning of year 3, now at the beginning of year 3, the machinery was revalued to 3 crore. Now at the beginning of year 3, the previous question it was at the end of year 4. Correct? Yes, sir. With the surplus on revaluation being credited to revaluation reserve, depreciation was provided on revalued amount over the balance useful life of 8 years. You can see out of 10, 2 year expired to 8 year. Okay. The machinery was sold in current year for this much. Give the accounting treatment for the above in the company's account. What will treatment if the machinery fetch only 42 lakh 50,000 now? So this is also based on derecognition. Derecognition, correct. So one question I am taking derecognition. So derecognition, detailed discussion will do in the last point. But you know sales and entry. If you know sales and entry, I can explain na. Chalega? Yes, sir. So question number 50. We are doing question number 15. Okay. What is the initial cost they have given? First, we'll find out carrying amount on the rate of sale. So sale happened when? Sale happened after revaluation only. Correct. The machinery was sold in the current year for, so current year means what? At the beginning of third year. So they have not given whether it was sold at the end of third year or at the beginning of what? Third year. That is not given. So we need to assume at the end of third year only. That only we need to assume. Okay. From here it is given. The machinery. Okay. Chalega. But here it is given at the end of year 5. It is given at the end of year 5. Acha, 5 years ago. Oh, देखो 5 years ago. So it was the machinery was acquired 5 years ago. So 5 years ago means current year is what? 5 years ago. So current year is 6th year. Correct now? Got this point? Yes, sir. Very good. So Skanda acquired a machinery for 2 crore 50 lakh 5 years ago. And depreciation was charged at a rate of 10% per annum SLM basis. 10 years is the useful life. At the beginning of year 3, in year 3, what happened? Depreciation at the beginning of year 3 means at the beginning of year 3, the machinery was revalued. Okay, sir. Let me explain this question. We are doing question number 15. Whenever they don't give the date now, there is a lot of confusion. This is Y0. Y0 means what? Beginning of first year. What is the cost price they have given? Cost price they have given how much? 2 crore 50 lakh. 2.5 crore. Useful life is 10 years. Okay. Then at the beginning of, this is Y1, this is Y2, this is Y3, this is Y4, and this is Y5. Okay. So machinery was acquired 5 years ago. It means we are in the 6th year. This is our current year. This is our current year. Okay, sir. Chalega. Now, machinery was revalued at the beginning. This is year end 2. So this is beginning of year 3. Beginning of year 3. And it was revalued means on this date, fair value is equal to 3 crore. Now we can do. First, we'll find out carrying amount of machinery at the end of year 5. Calculation of carrying amount of PP. PP means machinery at year end 5. So what is the initial cost? Initial cost is how much? 2 crore 50 lakh. From this, first we'll deduct accumulate depreciation for 2 years. So you'll do 2 crore 50 lakh. Useful life is 10 and expired life is 2. Correct now? This will be how much? This is 50 lakh. 50 lakh is the 2-year depreciation. You can do also 10% into 2 also you can do. So what is the carrying amount at year end 2? That is 2 crore. Now at the beginning of year 3, there is a revaluation. Add revaluation gain. Revaluation gain. So now it becomes 3 crore. It will be increased by 1 crore. And you can see the revised carrying amount. Revised carrying amount at year beginning 3. At the beginning of year 3. That is 3 crore. And that is nothing but fair value. Now because it was sold in current year, so we'll assume that it was sold at the beginning of year 6. We need to assume that only because they have not given the date. In the current year is sold. We will charge depreciation for again what? 1, 2, 3 years. So less accumulated depreciation. Accumulated depreciation for what? 3 to 5 years is 3 years. So what will do? 3 crore. What is the balance life? That is 8 years. 8 into 3 you will do. It is 3 crore divided by 8 into 3. That is 11 lakh. Sorry. It is 1 crore 12 lakh 50,000. So what is the carrying amount at year end 5? That is 1 crore 87 lakh 50,000. Understood? This much have you understood? You can see they have also calculated 1 crore 87 lakh 50,000. Then now they are given two cases. Case 1, it was sold at this amount. Case number 2, it was sold at this amount. To write down case 1, case 2. Point number B. Calculation of gain or loss on sale. Calculation of gain or loss on sale. Case 1, case 2. Here the sale price is equal to how much? That is 1 crore 12 lakh 50,000. Here the sale price is equal to how much? That is 42 lakh 50,000. Correct? Understood? So what is the sale price? that is 1 crore 12 lakh 50,000 and 42 lakh 50,000 less carrying amount of machinery on the date of sale, that is 1 crore 87 lakh 50,000, 1 crore 87 lakh 50,000. So in both cases there is a loss. So loss on sale, and this loss on sale will be transferred to PL account. This cannot be adjusted with revaluation surplus because on de-recognition, revaluation surplus will be transferred to revenue reserve. So this will be transferred to PL irrespective of balance in revaluation surplus. Got this point? So it will be how much? 75 lakh loss, and this will be 1 crore 45 lakh loss, and both will be transferred to PL. Both will be transferred to PL. Understood? Just see the answer. You can see 75 loss and 1 crore 45 lakh loss. Both will be recognized in PL. And can you see nothing is given? What you will say? Balance of revaluation surplus means option number 1. You will say, and balance of revaluation surplus. What was the revaluation surplus? That is 1 crore will be transferred to our revenue reserve. So write down. Balance of a revaluation reserve will be transferred to revenue reserve on de-recognition date. So always take option number 1. If the question is silent, always do the easy one because ICAI is also taking easy one. Will not do by our own. That additional amount of revaluation surplus will be transferred to what? Additional amount, sorry, amount of additional depreciation will be transferred from revaluation surplus to revenue reserve. That will not do by our own. So in this case, 1 crore. Here also 1 crore. Got this point? Good question. You can see 1 crore, 1 crore has been transferred. Retained earning and revenue reserve are same. You can also write down retained earning. Both are same. Retained earning चलेगा. Got this point? Any doubt? चलेगा. Write on MRQ. Good question. So we have done 2 questions. You try these 2 questions by your own. We'll also take one of these questions tomorrow. So today this much only. Revaluation surplus you understood. Now only depreciation is left. And then means tomorrow I think most of the part of this AS10 will be able to complete. Okay, sir. So I take normally some time for AS10. AS10 will normally take what? More than 3 class. More than 3 class. Okay, sir. So balance 2 question, just try by your own. Let's see whether you are able to do it by your own or not. Okay, sir. Thank you very much for today. We'll meet tomorrow. Till then, bye bye. Take care. Enjoy your remaining day. Bye bye.